This is the Regal Imports News for December 2016. Instability is never good for business. The divisive U.S. election has created instability, and the fact that no one knows how Donald Trump will react is causing an overall cautious attitude. Instability and the possibility of higher interest rates are responsible for the rise of the U.S. dollar. Currency traders are moving to the dollar as a safe haven. Auction sales of luxury items like art and rare diamonds have been very successful as of late, as the rich sink their money into secure hard assets outside of traditional financial investments. Now that 3 new Canadian mines are in production, there are predictions that the new quantities of rough coming into the market will result in a glut of rough and force prices down. The diamond market can be compared to the oil market, where new mining techniques such as fracking make oil easier to tap. The new oil finds in the United States make the U.S. much less dependent on world oil supplies, and the new abundance of oil is putting downward pressure on prices. The same with diamonds. There may be a long-term shortage of natural diamonds, but there is currently a short-term glut. I personally believe that diamond miners have sold their production without due consideration for demand or the long-term health of the diamond industry. Note the Rappaport quote of the week. The risk for rough prices to be repriced lower because of increased supply is higher than any time in the last 24 months. I have no predictions about seasonal polished demand. Predictions mean nothing, as no one seems to accurately gauge the mood of the public. Mainstream press is predicting that retail sales will rise a few percentage points in the United States. However, there is a distrust of the press, and that extends to the diamond news reports. There are many who believe that presenting a false positive will somehow stimulate the market. The fact is that world economics are changing and nothing is predictable. My best advice is to work hard, be tech savvy, and specialize if you wish to remain relevant. Contrary to the optimism of the press, Signet, the largest jeweler in the United States, is reporting lower sales for the second quarter in a row. 334 North American jewelers closed operations in the third quarter. Hearts on Fire sales slumped in the first half. Downstream marketing continues to take a chunk out of retail business. The Delumi Group, an Israeli diamond manufacturer, purchased the online jeweler Zora. The Israeli Diamond Boursa is promoting partnerships with online retailers like James Allen and eBay. Diamond miner El Rosa is finalizing work on a polished diamond investment platform that will be open to the general public in March of 2017. And Blue Nile has been purchased by an investment firm for the outrageous amount of $500 million. Livish Polenauer points out that Blue Nile has yearly sales of $500 million. These sales contribute to a meager net profit of $6 million. He claims that, on the surface, the amount paid for Blue Nile seems irrational. He goes on to say that online companies can be purchased for many varied reasons, and those reasons can account for unusual purchase prices. He feels that De Beers and perhaps some larger Indian companies are involved in the purchase of Blue Nile. He sees the move as a possible game changer, an attempt to eliminate all middle players by connecting mine to consumer. If his supposition is correct, then all of a sudden the $500 million price does not seem so irrational. This theory is just conjecture, but it is an eye-opener and a possibility. Meanwhile, we, the wholesalers and retailers who hold on to the middle ground, need more than ever to differentiate by whatever means possible. Instability in the Asian market is causing many Asian firms to enter the lucrative U.S. market. International trade is struggling to understand the position of the President-elect on international trade agreements, and all business can do is wait and see. I am not saying that we are headed for disaster. In fact, it could be quite the opposite. I am saying that this wait-and-see attitude will put a damper on speculative investment. In such a business climate, the diamond industry cannot afford a scandal. There is talk about diamond transfer pricing taking place on a large scale, not only in Dubai, but also in the United States. Transfer pricing means that diamonds are shipped in and out of different areas of the world at higher and lower prices to avoid paying tax. Transfer pricing is a form of money laundering. Reuters has reported that several Italian banks have partnered in a scheme with a group of diamond brokers that defrauded Italian investors of $300 million by selling investment polished diamonds at twice their market value. On the point of diamonds as an investment vehicle, Nurit Rothman points out that De Beers sorts their rough diamond production into 11,000 different categories. And polished gem quality diamonds come in hundreds of different categories based on particular permutations of cartage, clarity, color, cut, and shapes of the stones. It is virtually impossible to substitute one diamond for another. It is impossible, therefore, to qualify a rough or polished diamond as a commodity. If industry can get their collective heads around the idea that diamonds cannot and should not be sold as a commodity, then they could put all that excess energy into productive marketing of generic diamonds as a personal and individual expression of love. And with that, all of us at Regal Imports wish you the love and joy that comes with the holiday season. Merry Christmas and Happy Hanukkah.